There are 9 major financial mistakes that people make in their 30s. Now, these aren't like stop by Starbucks and make your own coffee at home type mistakes. If you make these mistakes, you'll be paying for them for years to come. Now, the good news is that once you identify them, they are fairly easy to fix. Number 1 is ignoring history's financial lessons. So back in 2013, oil was trading around $110 a barrel, and I was a financial advisor at a credit union in Saskatchewan at the time. And everyone I knew in oil was making like 6 figures. Now, I noticed that my clients' paychecks came from oil, their pensions were invested in oil, and their portfolios were loaded with oil stocks. So they were essentially all in on one bet. And when 2014 and 2015 rolled around, the price of oil plummeted and eventually hit rock bottom at $25 a barrel in 2015. Now, what happened was their investments and retirement portfolios collapsed and their jobs disappeared overnight. I kid you not, we got panicked calls from people, 20s, 30s. They were selling their houses and their trucks just to survive financially. So you might think that you're immune from this because your industry is stable at the moment. But if you work in tech, AI, or real estate, and you're invested in tech, AI, or real estate, you are in the exact same position. Now, you might not recognize it yet because your industry might appear strong and the returns might be good, but you are in the same position, being over-concentrated with your human capital and your investment capital. And this is where a guy named Moshe Milevsky, he's a professor in Toronto, he changed my perspective on this and how to locate your assets based on your employment by asking a simple question. Are you a stock or are you a bond? If you're something like a tenured professor, your income is safe, so you're a bond. So you should invest like a stock, take risks. But if you're a business owner or an executive in a volatile industry, your career is volatile, so you are a stock. Therefore, your portfolio needs to be in a lower risk and hedge the risk of your career. So wealth creation is really only half the equation. Wealth preservation is just as important, and don't let your career and your portfolio collapse on the same day. Number 2, buying dumb stuff to look rich. Look, the BMW feels cool and the Rolex is super flashy, but no one really cares. And actual wealthy people, they honestly don't flex their wealth. You would probably never know them to see them. Going back to my time as a bank teller, I probably saw 30 to 40 people a day. And this was back when people actually went into bank branches. And the ones wearing the nice suits and the flashy watches were never really the wealthiest people. It was the guy in a t-shirt and shorts getting out of a Toyota. Now, simply ask yourself this question. Would I rather look wealthy or would I rather be wealthy? It's very easy to spend thousands of dollars a month on status symbols that add no real long-term value to your life and even have really short-term value adds. If you're in your 30s, guys, this is your prime earning years. And life is already pretty expensive because you've got kids, activities, social life. So if you spend your surplus or money on dumb stuff to try to keep up with what you see others doing online or whatever, it's just so stupid. Like, Instagram wealth is not real wealth. Everyone rents everything there. It's fake. It's not the real world, but trying to keep up with what you see on there can affect you in the real world. And I've personally advised people now in my financial planning practice who make mid to high 6 figures, and they come to me and ask like, Sam, where has all my money gone? Because I feel like I'm making a lot, but I honestly don't know where it's going. And when we plug their bank statements into our cash flow software, we find that unnecessary spending is causing them to actually run deficits. I've seen people spend thousands of dollars a month on shopping. They're going into debt just to look the part of a wealthy person. Also, I've seen people try to keep up with their peers. And this is a big one. Like, if you're a high earner, you may have peers who are earning more money than you or going into debt to finance their lifestyle. So things like private school, things like the country club golf course, things like luxury vehicles. Look, that is a recipe for staying poor because it's not about how much money you make. It's about how much money you can keep. You can have nice things, but just budget for them and spend your money on things that add real value to your life. If you do this, you set yourself up so that when you're in your 40s and 50s, working becomes an act of fulfillment. You're just doing it to be productive versus as a necessity. These years are crucial to your long-term wealth. Now, there's a famous quote that I really like, and I can't remember who said it. I think it's been recycled through, but I think maybe Bezos said it originally. He said, you overestimate what you can get done in 1 year and underestimate what you can get done in 10 years. So putting your head head down in your 30s, making sure you don't overspend on things you don't need is crucial. So guys, don't buy dumb stuff to look cool and impress people who don't care. Number 3, thinking you make too much money to need a budget. So as I mentioned before, I was a financial planner, I was a bank teller, and when I saw someone with high balances in their accounts, I basically just asked them for their secret. And I always expected to hear about a genius business idea or maybe an inheritance, but the answer was pretty much always boring. They were forced to budget when they were broke, but instead of stopping once they started making real money, they kept it going because it had been ingrained in them as a habit. And this is what helped them keep the money when they started making more. So it wasn't always just about increasing their income. Sure, that happened, but when they increased it, they actually had to save the money and not increase their lifestyle. Guys, when we're in our higher income earning years in our 30s, don't lose sight of this. You may have leveled up from your 20s, but you will not level up in wealth until you learn this lesson. Number 4 is trying to outsmart the room with investing. Most of us assume that investing is a winnable game. Like if I can just pick the right stocks, I can 10x my returns. But look at professional portfolio managers for a second. These guys have PhDs and access to the data by the millisecond. And by the way, they're on the other side of your trade. So like if you buy a stock, you know, who's on the other side is the guy who's selling it. And that's the guy with all the data, right? So somehow we think though, if I just try hard enough and keep up with the news, I can beat them. But even with these professionals, over 90% of these professionals underperform the very index they are benchmarked against. And this is what this means. So portfolio managers managing large cap US growth portfolios. So big companies in the US are usually benchmarked against the S&P 500. And 90% of those portfolio managers underperform the S&P 500. And it's the same in nearly every sector. And these are the guys that move markets and even they are losing. So we need to be honest with ourselves. If the portfolio managers with the Bloomberg terminal and math degrees and CFAs can't beat the market, then you trading on your iPhone in between meetings have absolutely no chance of getting good long-term returns over and above what you could just get by investing in an index fund. It doesn't mean the game is rigged. It means that markets are efficient. So stop trying to win a game that even the professionals are losing. And men, we are specifically susceptible to this because as men, we treat investing like a skill game. We think if we read enough news, check enough charts, and learn the basics of technical analysis and act fast enough, we can outsmart the room. We think we have some sort of edge, but the data proves that this edge is actually costing us returns. And we aren't losing because we don't know enough. We are losing because we are overconfident. Now, there's a study done of over 35,000 investors that proves what I'm saying. I'm not just pulling this stuff out of thin air. The study found that single men trade 67% more often than women. And the hypothesis of the study was this causes men to underperform. So we tell ourselves that by trading, we're like managing risk or we're optimizing or whatever we'd say, but we're actually just gambling. The study found that the trading activity causes men to underperform women by 1.4% every year. And women are already underperforming a simple index fund strategy. Therefore, we are well underperforming what we could be doing by simply just investing our money in a low-cost index fund. So I'm imploring us here to ditch those ridiculous covered call strategies, the single stock allocations, and as Ben Felix puts it, the thematic ETF slop, because you won't get rich through trading. You very well may get rich through your savings rate and focusing on increasing your income by getting better at your job or growing your business. Number 5, the passive income lie. Everyone thinks that passive income is the dream. You hold your dividend portfolios and your real estate and just watch the money roll in. But that's mostly garbage. Real estate's not passive, number one. It is ridiculously hands-on and extremely time-consuming unless you invest in something like a REIT, which is a passive real estate fund. And if you invest for dividend income, well, I guess technically that may be passive because you're not working to receive it. There's research papers like The Irrelevance of Dividends and many others that have proven that focusing on dividends is a suboptimal way to invest. Instead, we should be focused on total returns. And when we need money from our investments, we sell some. So people who advocate for dividend investing simply don't understand math. They see it as some sort of free money, but the reality is that when a company pays out a dividend, there is a dollar for dollar decrease in its intrinsic value. And there has to be. It's simple economics. If a company is paying out profits, then it is distributing dollars. Therefore, they are worth less. It has less money, therefore it is worth less. So I'm oversimplifying this a bit, but there's plenty of research papers that prove that dividend policies set by the company board of directors are completely irrelevant to whether or not the company is a good investment long-term, and that's really all we should care about. Now, you will find plenty of dividend influencers saying something different, but I'm imploring you to just look at the math, not the anecdotal experiences that Dividend Jim on Twitter shares. There's plenty of research papers out there and plenty of great information out there, so look at that. Now, not to mention that dividend distributions are taxable, and in your 30s, you should be trying to reduce your taxable income, not increase it. So there are plenty of reasons to avoid dividend strategies, but ultimately, it just boils down to understanding math. Number 6, the $500,000 cost of waiting. Most of us in our 30s see retirement pretty much as a lifetime away, but studies have shown that up to 74% of retired men and up to 60% of retired women regret not starting to save for retirement before the age of 40. So we cannot keep putting this off until later. The median net worth for people ages 55 to 64 is $364,500. If we reverse engineer someone building a $400,000 portfolio starting from zero at age 40, they would need to invest about $10,302 per year. Like, that's assuming about a 6% rate of return. But if they started at age 30 and invested that same $10,302, they would only have invested an extra $103,000, right? Because there's an extra 10 years at $10,300 per year. But they would have over $889,000, which is over $500,000 more, assuming the same rate of return. So if you fail to invest and fail to let compounding returns work hard for you in your 30s, you will have less time and require more money to catch up in your 40s and 50s. Save yourself the stress. Start planning for retirement now. Start saving for retirement now. Number 7, and this is a big one, failing to have financial clarity with your spouse. One of the biggest financial mistakes people make, and it's not talked about nearly enough, is not having real conversations and real financial clarity with your spouse. There's some sort of like quiet belief, I think, that a lot of couples have that goes something like this. If we just made more money, all of our problems would stop being an issue. But the data doesn't support that. More money doesn't reduce financial stress. If the communication isn't there, it usually makes it worse. So researchers have been studying this for decades, and money consistently shows up as the number one source of conflicts in marriages. In fact, surveys show that roughly 60 to 65% of couples who argue say that finances are a primary cause of those arguments. So if money feels like a recurring tension point in your marriage, you're not alone. You're actually in the majority. And a lot of couples don't even argue about this stuff. They just stop talking about it altogether. Studies out of both the UK and out of Canada show couples find money harder to discuss than children, chores, responsibilities, and sex. One Canadian poll even found that over 20% of partners outright avoid money conversations, and nearly a quarter say it's more stressful to talk about money now than ever before. I cannot stress this enough though. Avoiding these conversations has consequences. More long-term research consistently shows that financial conflict is one of the strongest predictors of divorce, often ranked second only to infidelity. So depending on the study, 20 to 40% of divorces cite money as a major contributing factor. One large survey found over 40% of divorced Gen Xers specifically blamed financial disagreements for the breakdown of their marriage. When you hear people say like, oh, we don't fight about money in our relationship, that usually just means that they don't talk about it anymore. Now think about this. Divorce is expensive, like objectively expensive. Aside from like the emotional and issues with kids and joint custody and divorce and assets and all of this separation and single income, duplicated housing costs, and all of these long-term disruptions, divorce itself costs $10,000 to $15,000 just in legal fees. But couples will avoid a 1-hour uncomfortable money conversation to protect themselves from some sort of discomfort and push all of these really big issues that can cause huge marital disruptions just down the road. Now, the research is very clear that shared financial clarity also correlates strongly with marital satisfaction. And one study found that 87% of couples who described their marriage as great actively work together on long-term goals. Among couples who said their marriage was okay or in crisis, that number dropped to about 40%. The simplest way to gain alignment with your spouse is a monthly money meeting. Once a month, same time every month, put it in your calendar. In this meeting, go over what came in, what went out, what's coming up, and whether you're still aligned on your financial goals. But don't approach this with judgment and an I told you so attitude, because you guys both need to buy into this. If one person feels like the finger is always being pointed at them when they dive into these meetings, it's literally just not going to work. So aside from this, With your spouse, create 1 to 2 major cash flow goals together. Things like save 10% of my income or pay off all consumer debt. And this is the fun part. Like, think about how exciting it can be when you and your spouse align on your financial goals and actually work together. It's one of the best things about marriage. And my wife and I, we've been married for 11 years. We have a really strong marriage, 1 kid, 1 on the way. And this is one of those things that we have so much clarity on, is we're aligned on our financial goals. So I'll leave you with this. No income level fixes poor communication. 6 figures doesn't solve it. 7 figures doesn't solve it either. But couples who face money together are far more resilient even when things go sideways. So if you want fewer fights, less stress, and a lower likelihood of a financially devastating divorce, get aligned with your spouse around money. Number 8 is the $1 million tax blind spot. As a Canadian CFP professional, I see most people when they book a call completely underestimate the cost that comes with a lack of tax planning. Business owners are especially susceptible to this. I have literally seen a lack of tax planning cost people millions of dollars. And almost every business owner I meet thinks they are set up correctly, but when we look under the hood, the structure is a disaster. They miss things like the lifetime capital gains exemption, which allows them to sell the shares of their business for up to $1.25 million completely tax-free, but only if this is set up correctly with the proper corporate structure. They also fail to multiply the capital gains exemption to family members using family trust. They also treat their corporate checkings account like a personal checkings account. They get behind on their income taxes, and to top it all off, what most people don't know is, like, if they pass away without the right structure, the government can literally come in and tax their corporate dollars up to 66.67%. So 2/3 of your life's work, your life savings could be gone. Also, I've seen executives and high earning employees, people with equity compensation, they'll come in without the slightest clue of the tax implications of their vested shares, of the stock options that are in the money that they want to trigger. They are not set up well for tax planning, and it's costing them tens of thousands of dollars. And in the cases of business owners, it can literally cost you millions of dollars not to be in the right structure with the right tax planning. So I get this question all the time, and it's like, well, Sam, it's just not fair that the government sets these traps. And you're right, it's not fair, but look, guys, this is the world we live in, and you can choose to ignore it, or you can choose to play the game. Here's another kind of truth about the game that most people don't realize. It's that good tax planning doesn't mean paying less tax this year. Sometimes you pay more tax today to facilitate a strategy that saves you hundreds of thousands or millions of dollars in taxes over your lifetime. Now, if you're in a complex scenario, like you're a business owner or a highly paid executive, you need a tax planning partner on your team who looks at the next 30 years, not just the next 12 months. You need to get your books in order. You need to pay your taxes on time. You need to have a clear understanding of exactly what financial position your business or your personal net worth is at any time at a glance. Not doing these things is just one reason why so many business owners find it too difficult to persist and manage all the things about running a business and eventually just give up. Because it's more than just about your business, right? Like, if I could just focus in on financial planning and not have to worry about the tax and all of this stuff in my business, I mean, that would be so cool, but I have to worry about it. So I need legal tax partners to help run this side of the business. This is crucial, guys, but for most of us, it's outside of our area of expertise, so we do need to bring in partners who understand this. Mistake number 9, failing to invest in your health. Ask any unhealthy but wealthy 60-year-old if they trade places with a healthy 30-year-old. Almost all of them would say yes. But most people in their 30s don't actually invest in their health like it matters, even though it's the one asset that determines how long you can work, think clearly, and produce income. In my opinion, investing in your health is the highest return investment you can make in your 30s. It directly extends your productive years and your ability to build wealth. Now, Warren Buffett once said, you only get one mind and one body, and you can't start taking care of it when you're 50. But taking care of your health isn't free. Eating properly, training consistently, managing stress, all of it has costs. It costs time, it costs money, it costs effort. And when you're in your 30s, it's really easy to justify skipping this stuff because, our health hasn't really caught up to us yet. We pretty much feel fine ingesting garbage. We feel fine if we don't work out. When I turned 30 though, I started digging deeper into health, and I've always been like an athlete, but I wasn't actually prioritizing my health. And around the same time, my wife and I, we were expecting a baby, and I had this thought, like, I want to be there for him. I want to make sure I'm not the tired dad that doesn't have energy to chase him around or play baseball with him or teach him how to play soccer and basketball. I realized I needed a long-term plan and a commitment to eating properly and lifting weights. Now at 32, I can honestly say it's been a night and day difference. And here's the part though that people push back on. It wasn't cheap. I spend roughly $200 to $400 a month on health and wellness. And on paper, that looks like a big expense. But that money spent has been one of the highest ROI decisions I've made because the biggest benefit wasn't just physical. The discipline I built through training and eating well spilled into everything else. So I became more intentional with my money. I became more structured with my money management. I had more focus in my career, like in my business. I could dial in for longer periods of time. I was feeling healthier. My mind was healthier. There's a really good quote that I like from Jim Rohn. He said, "Discipline weighs ounces, regret weighs tons." So working on your health isn't just about living longer. It's about building discipline, and it's about becoming the type of person who does hard things consistently. So guys, never stop working to be the best version of yourself. If you found value in this video, please share it with a friend or someone else who will find value in it. I use these metrics to let me know this is the type of content that you want to see.